The Federal Reserve, often called the Fed, has decided to keep interest rates steady. And while that might sound like nothing has changed, this decision is actually very important because it reflects the current condition of the economy and where things might be heading next. The Fed is the central bank of the United States, and its main role is to manage inflation, support employment, and maintain overall financial stability, which means its decisions can influence almost every part of the economy and directly impact people's financial lives. Even though most people don't pay attention to these announcements, the reality is that the Fed's decisions affect everything from loan costs to job opportunities, and even the prices you pay for everyday goods and services. One of the main tools the Fed uses to control the economy is interest rates, which determine how expensive or cheap it is to borrow money. And this single factor can influence how people spend, save, and invest their money over time. When the Fed raises interest rates, borrowing becomes more expensive, which discourages people and businesses from taking loans and spending money. And this slowdown in spending helps reduce inflation by lowering overall demand in the economy. On the other hand, when the Fed lowers interest rates, borrowing becomes cheaper, which encourages people to spend more and businesses to invest and expand, helping to boost economic growth during slower periods. This balance between raising and lowering rates is how the Fed tries to keep the economy stable. But it is never a simple decision because every move has both positive and negative effects on different parts of the economy. In this situation, the Fed has chosen not to raise or lower rates, which is known as holding rates steady. And this usually signals a cautious, wait and see approach because policymakers are uncertain about what might happen next. Inflation in the United States has come down from previous highs, but it is still above the level that the Fed wants, which means the problem is not fully solved yet and still requires careful attention. At the same time, the economy is starting to show signs of slowing down due to earlier interest rate increases, as higher borrowing costs have already reduced spending and made it harder for businesses to grow quickly. Because of this, the Fed is trying to balance two major risks, where raising rates too much could slow the economy too quickly and lead to job losses, while lowering them too soon could cause inflation to rise again. This creates a difficult situation where the Fed must move carefully, and holding rates steady becomes a way to observe how the economy reacts before making the next big decision. Even though this decision may not seem dramatic, it actually sends a strong message that the economy is currently in a sensitive phase where stability is more important than sudden changes. For businesses, this means being cautious with investments and expansion, while for individuals, it means dealing with a financial environment where borrowing is still expensive and costs remain relatively high. Most people ignore these types of announcements because they sound technical and complicated, but in reality, they have a direct impact on everyday life, influencing how much you pay in interest, how much you can save, and how far your money goes. Understanding this at a basic level can give you an advantage, because instead of reacting blindly to changes, you can make smarter financial decisions based on what is actually happening in the economy. Now let's talk about what this decision actually means for your money, because this is where things become more personal and directly connected to your daily financial life, as interest rates influence almost every financial decision you make. When the Fed holds interest rates steady, it means borrowing costs are not increasing further, but they are also not decreasing, which creates a situation where financial pressure remains but does not get worse immediately. If you have loans such as a mortgage, car loan, or credit card balance, this decision affects how much interest you continue to pay, and since rates are still high, borrowing money remains expensive for most people. This means that monthly payments on loans stay relatively high, and for many individuals, this limits their ability to save, invest, or spend freely, as a larger portion of their income goes toward interest payments. At the same time, if you were expecting lower interest rates to reduce your financial burden, that relief has not arrived yet. which can be frustrating for people hoping for easier financial conditions. On the positive side, higher interest rates can benefit people who have savings because banks tend to offer better returns on savings accounts, allowing your money to grow slightly faster than before. However, this benefit is not as strong as it seems because inflation is still reducing the real value of your money, meaning that even if your savings are increasing, your purchasing power may not be improving at the same rate. Another important effect of steady interest rates is on spending behavior, because when borrowing is expensive, people tend to spend less and think more carefully before making big financial decisions. This slowdown in spending can reduce demand in the economy, which helps control inflation, but it can also slow down economic growth, creating a more cautious financial environment overall. For businesses, this means being more careful with investments, hiring, and expansion, because higher borrowing costs make it more expensive to grow and take risks in uncertain conditions. As a result, job growth may slow down, and wage increases may not rise as quickly, which can affect household income and overall financial stability for many people. For the average person, this creates a mixed situation where prices may not rise as quickly as before, but they are still higher than normal, while income growth may not keep up with these costs. This is why managing money becomes more important in this type of environment, because small financial decisions can have a bigger impact when conditions are tight. The Fed's decision to hold rates steady is essentially telling you that the economy is not in crisis, but it is also not fully strong, which means you need to be careful and strategic with your finances. It also means that financial conditions are likely to remain similar in the short term, so expecting quick improvements may not be realistic, and planning based on current conditions becomes more important. Understanding this helps you make better decisions, because instead of waiting for things to change, you can adjust your spending, saving, and borrowing habits based on the reality of the situation. In simple terms, the Fed has pressed pause, and during this pause, your financial choices matter more than ever because you are operating in an environment where money is still expensive and stability is uncertain. Now let's bring this down to real life, because this is where the Fed's decision actually starts to affect you in ways that you can feel every day, whether you realize it or not. One of the biggest impacts is on credit cards, because most credit card interest rates are directly influenced by the Fed, and since rates are still high, carrying a balance becomes very expensive over time. If you are only making minimum payments, a large portion of your money goes toward interest instead of reducing your actual debt, which can keep you stuck in a cycle that is difficult to escape. This means that even if your income stays the same, your financial pressure increases because your money is not being used efficiently and a part of it is constantly lost to high interest costs. Now think about buying a home, which is one of the biggest financial decisions most people make. And with interest rates still high, mortgage payments remain expensive, making homes less affordable. Many people are delaying buying a house or settling for smaller options because higher rates have increased monthly payments significantly compared to a few years ago. The same situation applies to car loans, where financing a vehicle has become more costly, and this affects what people can afford, forcing them to either delay purchases or accept higher long-term costs. Beyond loans, the impact is also visible in everyday expenses, because even though inflation has slowed down, prices for essentials like food, rent, and utilities are still higher than what people were used to. This creates a situation where your income does not stretch as far as it used to, and many people feel like they are working just as hard but getting less in return. This feeling is not just in your head, but a real effect of economic conditions where costs remain high while financial relief is slow to arrive. Another important area affected by interest rates is the job market, because when borrowing is expensive, businesses become more cautious with spending and expansion. This can lead to slower hiring, fewer job opportunities, and limited wage growth, which affects not only your current income, but also your future earning potential. Even if you are not directly dealing with loans or investments, you are still affected through these indirect channels, which makes the Fed's decisions relevant to everyone. On the positive side, if you have savings, you may benefit from higher interest earnings, but this only helps if you are consistently saving and not relying heavily on credit. For many people, however, the reality is a combination of rising costs, existing debt, and limited financial flexibility, which makes managing money more challenging. All of these effects show how a single decision by the Fed can spread across the entire economy and influence multiple aspects of your daily life. From the interest you pay to the prices you see and even the opportunities available to you, everything is connected, and understanding this connection can help you make better financial choices. So the big question is, what should you do now in a situation where interest rates are high, borrowing is expensive, and the economy is still uncertain? And the answer starts with focusing on what you can actually control in your financial life. The first and most important step is managing your debt, because high-interest debt, especially from credit cards, can quickly become a major financial burden if it is not handled properly. Since interest rates are still high, carrying debt means you are constantly losing money through interest payments, which makes it harder to build savings or move forward financially. This is why reducing or paying off high-interest debt should be a top priority, because every payment you make toward it is like earning a guaranteed return by avoiding future interest costs. At the same time, you should be careful about taking on new debt, especially for non-essential expenses, because borrowing money in this environment comes at a higher cost than usual. The second step is focusing on saving money, because even though inflation reduces the value of money over time, having savings gives you financial security and peace of mind during uncertain conditions. With interest rates still relatively high, savings accounts may offer better returns than before, which means your money can grow slightly while staying safe and accessible. However, saving alone is not enough, and you also need to control your spending, because rising costs mean that every dollar matters more than ever. Tracking your expenses and cutting unnecessary spending can make a big difference over time, even if the changes seem small in the beginning. Another important step is making smarter financial decisions, especially when it comes to big purchases like homes, cars, or major expenses, because timing and cost matter more in a high-interest environment. Instead of rushing into decisions, it is better to evaluate your options carefully and understand the long-term impact of borrowing money at higher rates. It is also important to stay informed, but not overwhelmed, because you do not need to understand every detail of economic policy, just the key idea that interest rates affect how you borrow, save, and spend. By understanding this basic concept, you can adjust your financial strategy in a way that protects you from unnecessary risk and helps you make better choices. Finally, focus on long-term consistency rather than short-term reactions, because the Fed's decisions will continue to change over time, but your financial habits are what will truly determine your future. People who succeed financially are not the ones who predict every economic move, but the ones who stay disciplined, avoid major mistakes, and adapt to changing conditions. This moment is not about panic or fear, but about awareness and control, because once you understand how the system works, you can position yourself in a way that benefits you instead of hurting you. The Fed has made its move, and now it's your turn to make smarter decisions, take control of your money, and build a financial future that is strong no matter what happens next. Thanks for watching. If you found this video helpful and want to stay updated on the latest financial news, smart money moves, and ways to protect and grow your wealth, make sure to hit that subscribe button and turn on the notification bell. Join the Smart Money Moves community today and never miss another tip that could help you take control of your money and make smarter financial decisions. Remember, knowledge is power, and every small move you make today can shape your financial future tomorrow. Encouraging, subscribe now and start making smarter money moves.